It's Brian Preston, the Money Guy.
We have a question from Brett on YouTube. He says, I am 30 years old and just locked in a 2.79% rate on a 30-year mortgage,
That's
which
incredible.
is awesome. Should I invest or pay down the mortgage? If I invest, by what age should I pay off my house? Thank you.
This is Brett.
Brett, yes.
Okay, Brett. This is a great question. And by the way, 2.7% on a 30-year.
Like, first of all, congrats.
That is like, oh my goodness.
Yeah.
That is like, too bad that's not going to be an assumable mortgage when you're ready to move out of that house, because you're going to look back on that rate and be like, that is a chance of a lifetime right there. But this is a great question. He is 30 years old, right?
Yep.
And look, I get it. When you're paying down debt, especially for any of my Dave Ramsey fans that are out there, it feels so good if you ever struggled with credit card debt, or if you had student loans, if you have car loans and other things. The day you pay those things off and you get the title in the mail like on your car, or you get the notice letter that your student loan is completely fulfilled, you have that emotional completely, I mean, you just know that your brain is like celebrating. Fireworks are going off. The problem is that there can be too much of a good thing. You take those celebrations of the debt you should be trying to extinguish as fast as possible, the credit card debt, the auto loans, and those other things. But then you look at and you go, wait a minute, okay, I have a mortgage at 2.7%. I'm 30 years of age, which we have shown the research that, yes, it's not 88 times over anymore, meaning that my dollar is not worth 88, but it is worth $23. Every dollar I invest today, by the time I retire, is going to be worth $23, whereas that mortgage is at 2.7%. I think that the money you have in your 20s, the money you have in your 30s, even the money in your early 40s is too valuable from a compounding growth standpoint. You got to put that money to work. Now, there does come a transition point, because realize, we showed on a 40-year-old that multiplier effect is only 7. So when you get closer to 50, where it's getting around 3 times multiplier, I'm okay if anybody over 45, I'm in that, by the way, if you want to have a goal to have your mortgage paid off, 45 to 55, 60, somewhere in there, I think it's healthy, because I want you to be completely debt-free as you approach financial independence. So anytime after 45, because the wealth multiplier has kind of come down a touch, why not go ahead and get debt-free? But get that order of operation correct so that you're not squandering those people in their 20s, that 30 times multiplier for people in their 30s, that 20 times multiplier. I think your money, your army of dollar bills, is just too powerful, and I just don't want you locking your army up inside that house, and then they're kind of banging on the windows, banging on the doors, going, let me out, let me get to work, and you got them all locked up when the opportunity cost was 2.7%, which you look back and you go, wow, that is cheap. Really cheap, especially when you take into account, I know not everybody's getting the mortgage interest deduction, but there's still, I mean, that is dirt cheap money historically.
Yeah. Thanks for your question, Brett.